Friday, December 15th, 2023, Maneco 64, home of alternative economics and contrarian views. So yes, the dollar has been weakening, especially as per the dollar index. But one thing we're going to look at today is how all currencies are sinking. It's not just the dollar. And you understand what I mean when we go through it, of course. And yes, the dollar index, I've said many times, is a bit of a distraction. So we're going to start with the Smithsonian Agreement. And you might be asking, what is the Smithsonian Agreement? Well, let's go through it because I think it's imperative and very important in understanding if you want to know what's going on in the currency market with the dollar, with the euro, with the pound, with the yen, with gold especially, of course, because gold is the ultimate measure of value. So I've referred to Investopedia here, and they've got something on the Smithsonian Agreement, what it is, how it works. So let's go through it. What is the Smithsonian Agreement? The Smithsonian Agreement was a temporary agreement negotiated in 1971. Well, that year keeps coming up, doesn't it? Well, let's continue. Among the 10 leading developed nations in the world, namely Belgium, Canada, France, West Germany, Italy, Japan, the Netherlands, Sweden, the United Kingdom, and the United States. The deal made adjustments to the system of fixed exchange rate established under the Bretton Woods Agreement and effectively created a new standard for the dollar as the other industrialized nations pegged their currencies to the US dollar. The Bretton Woods Agreement was a complicated system based on gold that began to unravel in the 1960s as the global stock of gold became insufficient to meet global demand for international reserves. Well, I've got a little comment here. It wasn't the global stock of gold that became insufficient. There's always enough gold. The problem was that countries, especially the United States, abused their privilege and created too many currency units not backed by gold. So what were they supposed to have done to stop this? Well, they should have raised interest rates, and that's how you maintain a gold standard at a fixed rate. Anyway, let's continue. The Smithsonian Agreement resulted in a partial devaluing of the US dollar. So yeah, that's the other thing you can do. Instead of raising rates, you devalue the currency. All that means is that instead of being for $1 getting 35, for 1 ounce, of gold getting $35, you get like 38. That's how much they devalued it. So it stops the flow of gold out of the country. But it was not enough to address the underlying issues of the Bretton Woods Agreement, and it lasted just 15 months before the broader system collapsed. I don't think there was a real underlying problem or issue with the Bretton Woods. The problem, of course, was that the country running it abused the system. But anyway, let's continue. The Smithsonian Agreement became necessary when the then U.S. President Richard Nixon, stopped allowing foreign central banks to exchange dollars for gold in August of 1971. A sharp jump in U.S. inflation rate in the late 60s had made the existing system unstable and was driving a shift to foreign currencies and gold at the expense of the U.S. dollar. Well, why did inflation rate jump? Well, because the U.S. government spent and borrowed too much. It wasn't because it popped up out of the blue. The move by President Nixon triggered a crisis which led to an appeal from the IMF for negotiations among the Group of 10. This negotiation in turn led to the Smithsonian Agreement in December of 1971. The agreement devalued the US dollar by 8.5 percent relative to gold. Why gold? Well, because as I told you, gold is the ultimate store of value, measure of wealth. And they knew that back in 1971, which isn't really that long ago. And it hasn't changed. Raising the price of an ounce of gold from $35 to $38. The other G10 countries agreed to revalue their currencies against the US dollar as well. President Nixon praised the agreement, wait for this one, as the most significant monetary agreement in world history. I think he was wrong about that, because less than 2 years later, it failed, as you can see here. I'll just go through it here. However, the par value system continued to deteriorate. Speculators pushed many foreign currencies up against their now higher valuation limits, and the value of gold was driven higher as well when the U.S. Unilaterally decided to devalue its dollar by another 10% in February 1973, raising the price of gold to $42 per ounce. It was too much for the system. By 1973, most major currencies had shifted from a fixed to a floating exchange rate relative to the US dollar. And I'm going to end here. And so we went from a system of honest weights and measure, because that's what measuring currencies against gold is, to a floating exchange rate, which is crazy, which is like having measures like inches, feet, pounds, kilos, change every day relative to each other. Can you imagine how crazy the world would be? And this is what John Exter as well described back in 1972 as IOU nothings. He said currencies today are IOU nothings. John Exter, of course, was a former Fed official. He was a gold bug, and I highly recommend you read this article that he wrote back in 72. Currencies are IOU nothings. And it's not just the dollar that's an IOU nothing, it's all the other major currencies and all currencies nowadays for that matter. So what's this got to do with the dollar index? Well, we're going to come to that in a minute. So before I go further, just wanted to remind you again that I've got a 10% deal for the viewers with the Dirty Man Safe. You can check all the details below in the description of this video. The Dirty Man Safe is a great way to keep your valuables safe, especially in this day and age where you don't know if your bank is going to open or not the next day. The other thing I wanted to say is that Miles Franklin still got its special on 1 ounce silver eagles, only $4.99 over spot. They've got maple leaves as well, gold maple leaves, 1/10 of an ounce, only $30 over spot. And they've got 90% constitutional silver, only $3 over spot. What does the Smithsonian agreement have to do with the dollar index? Well, as we saw there, the Smithsonian agreement collapsed in the beginning of 1973. So we went from a sane world where currencies were all kind of pegged to gold at a fixed weight. Currencies were pegged to each other, and that gave the system discipline. But after the Smithsonian agreement collapsed, all hell broke loose, so to speak, in the currency market, because countries and nations now could inflate to their heart's desire, so to speak. And that's why, of course, if you look at all the charts of inflation of debt since 1971 and 73 especially, they've all gone through the roof. That's because there's no anchor. But there's also a problem that they needed something to measure these currencies against the dollar. So that's why the dollar index was basically conceived, and that was in March of 1973, and it makes sense because the Smithsonian agreement collapsed in March of 73. And the dollar index, as you can see here on Wikipedia, yes, Wikipedia is not perfect, but for some things, it's pretty good, like for the dollar index. I'm going to put a link to this below in the description. You can read the whole thing. But as you can see, it started in March of 1973, and it was quoted at 100. And it started, of course, with all the major European currencies, the Japanese yen, pound sterling, Canadian dollar, Swedish krona, and the Swiss franc. In the year 2000, though, or is it 2002? I'm sorry. All the major European currencies became one in terms of the dollar index. It was the euro. So the Deutschmark is indirectly, for example, in the dollar index, but it was replaced by the euro. But it started at 100. And as I said earlier in this video, I've been covering the fact that currencies are all sinking, right? It's not just the dollar or the pound or the euro, but all of them. And they're sinking, of course, against gold. And hopefully you understand now how gold is important, how it was important back in the 70s, and how they try to keep it pegged to gold. But they gave up, of course, in 1973. And I would argue that all our troubles in terms of inflation, inequality, wars, social mores collapsing, it all started there really in 1973. And why is that? Well, because when the currencies become worthless or have no kind of anchor to something real, society hurts from that, because currencies are the lifeblood of the economy. It's half of all commercial transactions that we do. And if we deal with a bad currency, it's going to lead to a lot of bad things. But as you can see here, I've been trying to warn the world about this since 2007. And this is even before I started this channel. This is when I was still working in the financial sector here in London. And I did this for fun in my spare time. I had a website called forsoundmoney.com. I don't have that anymore. But the Market Oracle published currencies. They're all sinking. I'm going to put a link to this article in the description. The reason I'm showing you this is not to tell you that I predicted this, because it's not a matter of predicting. It's a matter of common sense. It's just realizing that this kind of activity will lead to the consequence, will give these consequences that we have. Currencies that are becoming worth less and less against real things, especially gold. So the dollar index, let's look at the chart of the dollar index, and it's a very long-term chart. And as you can see here, it goes back to 1967, and you might ask, well, you said it started in 73. Well, it's because they're able to go back, because the currencies that made up the index in 1973 were still around in 67 as well. So they were able to backtrack. But it actually started, as you saw there, from the Smithsonian agreement history in March of 1973, and it started at 100. And at the time, I think gold was trading around $85 per troy ounce. And recently, of course, in the last 2 years or so, the dollar has rallied strongly from around 90 in the end of 2020 to a high of almost 115 late in 2022, and now it's coming back down and it's approaching 101. And yes, it has dropped a lot, but as I said, it's against other fiat currencies. And what I'm trying to say here, yes, the strength and weakness of the dollar here will affect the price of gold and silver, but over the long term, as you can see, it's a major distraction. And what do I mean by that? Well, I mean that if you're going to save for the long term, your hard-earned, let's say, wealth, and if you're going to save monetarily, of course, I think there's nothing better than gold and silver to do it in. And I think playing this game of foreign exchange long term is a fool's errand. And what do I mean by that? Well, yes, the dollar is weak right now. Should you really buy the euro or the pound or the yen? I don't think so, because they're going to turn weak versus the dollar in 6 to 12 months. But I guess gold, they're all becoming really weak. We've gone from 100 in March 1973, and right now, as I look here at this system, we're just below 102. So the dollar index has gone up about 2% in more than 50 years. Gold, on the other hand, has gone from $85 to over $2,000. So you tell me what's the best currency or money to have. So enough of that. Let's quickly look at where the markets are this morning. It's 8:37 a.m. London time. We've got spot gold at 2,038, is up $2. High has been 2,040. I said that level is going to be important as a resistance. Yes, yesterday we broke above that, but we've come back below it. Low overnight has been 31. Silver is unchanged, 24.17. High's been 24.22, and the low has been 23.97. This is a really key level here. We need to break this trend line in silver. If we're able to close, let's say, around 24.50 today, that would be quite positive, I would say, in the short term. Dow futures up 89, NASDAQ 100 futures up 31, S&P is up 8. To the currencies, sterling is down 0.1 at 127.52. The euro is down a third at 109.50. The dollar is down a tenth versus the Japanese yen, 141.73. And the dollar is also down almost a third now versus the yuan at 710. Let's check the other currencies. The Aussie dollar is up 0.2 at 67.09. The dollar is down 0.2 versus the Canadian dollar at 133.82. And the Kiwi dollar is up about 0.2 as well at 62.16. Commodities, WTI crude is up 0.33% at 72.07. Brent is up a third as well, just below 77. Platinum is down $3, trading around 960, and high-grade copper is up 0.1% at 390. Quickly look at the 10-year yield. Yes, that's still below 4%. It's at 392. And is that because investors are confident in the U.S. government to lower their debt, so they're buying treasuries? No, I think it's got nothing to do with that. It's more to do with the fact that the Fed has come out and said they're going to start cutting and most probably even doing QE again. So they're front running the Fed. It's nothing organic, I would say. It's not like Yellen has come out and said we're going to stop running deficits and start running surpluses. So to those people who say there's demand for the dollar, you know, just because treasury yields are going down and treasury prices are going up, I think they're wrong about that. Or maybe I'm wrong. Maybe you have another opinion. And if you do, make sure you comment. Say something on the comment section to me, and I will debate you on that. So with that, I'm going to wish you all a very good weekend. Take care. Bye.